Tim Quast, founder of Market Structure. Ed, Mr. Quast, how we doing today?
Very well, thank you. How about you guys? I just caught the Tesla discussion, so I don't know what else happened. Any big drama over the weekend?
Well, I mean, everything is down, so if you consider that drama, then yeah.
Well, not everything, Spencer. Fortunately, what we told Edge subscribers to do, we said on Friday, just whatever you've got left in your retail trading account, take it out and put it on the 80-1 long shot at the Kentucky Derby.
Oh my gosh. We talked the horse race. I don't know if you heard the breakdown of it, but I'm not a big even fan of horses, but I do watch the big races. But that horse, nobody saw that coming, man.
The announcer didn't even know the name of the horse. He didn't even know what to do with this horse coming up on the inside.
Yeah, that would have been nice to put all my money on that. But let's talk about
we would never do that. By the way,
this market here. Tim, is there any market structure reason to suggest that there could be a short-term bottom at all?
Yes, there are actually. Okay. So number one, the way that we measure supply and demand in the market, and we measure the way that the behaviors that drive buying and selling wax and wane. Mm-hmm. Demand is at 2.9. So statistically, historically, throughout the entire data set, the probability of a gain from 2.9 is a number approaching 100%. Now, that doesn't mean it's sustainable. But so there's one that when we get well below 4, the lowest measure we've ever recorded, by the way, was March 23rd, 2020. It was 1.9. But so for perspective, this is one of the lower reads. So that's one reason. And then we've noticed this phenomenon, and I'm not, again, it's a data point about that's from market structure. So, I always tell people, why is the stock market down? Well, China's slowed down. We're concerned about recession, war in Ukraine. Okay, those are all external inputs that will affect people's behavior. But that's not how the stock market works. That's not the physics of the stock market. The physics of the stock market are A, the rules that govern how prices are set, and B, supply and demand. It's that simple. So another phenomenon we have seen around short-term gains for the market, which may very well be followed by further declines, is a steep surge in buying. It's happened 3 times year to date, and it happened after each of the preceding 2 dips, and that happened last week. So is there the high probability of a short-term, even today, as you listen to the dour discussion on various news sources from Bloomberg to CNBC about conditions, you never know. You never know how the day will unfold. It's a new week, but there are 2 reasons that it's possible that we have a short-term bottom. I don't think that we're there long-term yet.
Okay. What are the reasons that would be for a short-term bottom?
Well, so here and let me just show you this. So one of the things that we
and what's short term, Tim? Could you give us like week, 2 week bounce or something?
Week, 2 weeks. Week,
okay,
2 weeks.
I like that. Good, thank you.
Right. We have options expirations the week after this one. So I think those are important. The Russell rebalance gets pegged. Boy, what a mess that's going to be. Yes. Those are 2 very important things that are going to affect how people approach the market. But here's how. So this is the good and the bad. I'll show you broad market sentiment here. This is our read of supply and demand. So let me just zoom it in for you. So this green line, see, it's bottoming. It's at 2.9. That's a miserable read. The reason that the market continues to be weak is looks to
me like it's still going down. I don't know.
Trend doesn't look like your friend.
I don't know.
From a trend perspective, it's probable. Sure, it could change. From a trend perspective, it is probable. And if we look back long term, that's a pretty steep drop below the green line, which has statistically indicated a bottom. Doesn't mean it's immediate, just gives us a read. Okay. Here's the problem down below. Look at the supply side. It's as though in an economy, everybody stopped buying goods at the same time that the supply chain recovered and furnished the market with an unbelievable supply. What would happen to prices? Well, they would go down, right? So notice the short volume is all the same as 48% as of Friday. That means almost exactly half of all trading volume is either A, borrowed, or B, created. And what does that come from? It comes from market making, of course, but the other two inputs will be heavily leveraged inverse ETNs, exchange traded notes that are betting on a bearish market. So then the parties who are providing those will back them with a bunch of puts, and that'll show up that way in the data. So these are two offsetting forces, and that's what causes trouble. Nonetheless, if they reverse, what happened if this went down? Because it's not a static condition. It always goes down. Did the same thing here. So will it come back down? Yes, it will. And if demand picks up at the same time, we're going to have a short-term surge. Could it be into options expirations? Could be. Could be. And then I would fear the destruction to another handful of these synthetic exchange-traded notes. And in that context, just a funny little anecdote. I had a contractor at my house here in Denver doing some grout work, and he says to me, "Have you seen that NRGU?" Well, look up NRGU. It is a triple levered energy ETN, and it's staggering. It's got $67 billion worth of assets in it, making it one of the largest exchange traded stocks in the market. But that's where we are. Everybody has been so beaten up, they're leveraging into things. And that tends to be the later stage of a bunch of destruction. So, those two things kind of balance each other out.
So I sit here and I don't know what to do now, Tim. Like, part of me thinks, okay, I could play this short-term bottom, and the other part of me says, hey, long-term, Tim still says the going isn't that great here yet. So what do we do?
Well, then you have to be, as you should be anyway. You should be selective, and you should be very confident in the things that you trade. And how I would look at this is, as ever, you buy diverging supply and demand. And I'm going to go, so I put a couple of things here in the Benzinga May 9th portfolio. Notice that the read for the stocks in this portfolio, look at this, rising demand, falling supply. Those are the conditions that will generally produce gains no matter what else is going on. If you're very risk averse, a great opportunity would be Pepsi. Its intraday volatility is a quarter of the broad markets at 1.2%. It doesn't move a whole lot. It's at 5, right at the axis of supply and demand, and the supply side is down. So that's a place where if the market is rocky, you can probably preserve capital and produce modest gains. You have to set your expectation low. It's just 1.2% of intraday volatility. Or you could trade something like Phillips 66. So this is clearly comes with more risk because the broad sentiment reading is down. But if you look at the supply demand balance in PSX, that is exactly what you want to see. You want a steeply rising demand curve that is well over 5, well ahead of the market, and a supply side that has fallen back below trend and has a steep downward curve. Those are the kind of things that it's not linear, that will tend to produce gains. So for instance, I'm going to give you a little tip, edge traders. So if PSX today is down, and it's down at least half of the intraday volatility, 3.6%. So say it goes down 2%. If you buy it when it goes down 2%, the probability that you produce a return tomorrow or the next day is extremely mathematically high. Again, I'm kidding you not, it is close statistically to 100%. Why? Well, because the divergence down is due only to intraday trading, not the supply-demand balance, and that's an opportunity. I did that with AutoNation last week. AutoNation, great supply-demand. It's a extreme demand and plunging supply. So when the stock went down 3.1%, I bought it, and I produced a very nice return. But that's what you have to do as a trader in a market that is very forbidding. And you have to take gains, not chances, I'd like to say, but you want the math on your side. That's what I think, Dennis. I realize that is a market structure view, but it's a very reliable way to approach challenging markets.
I mean, and this is the tough thing. I mean, everybody's got an opinion out here, and obviously you're using a quantitative approach, and I'm a big believer in quantitative analytics. I'm a big believer in the quantitative approach to the markets. I try to do that in my regular trading as well. Obviously, you know, sometimes things work, sometimes they don't. But, you know, when you can take that bias out, and I often find myself having a bias on this show, but when I try to trade market neutral as much as I can. I'm trying to take advantage of little market inefficiencies when I can. And, you know, you try to give a little opinion and have some fun sometimes too. But it's difficult to, like, you know, for a human being, you know, to just go through it. So when you look at the quantitative approach to it and say, hey, you know, we're very oversold here and we're due for a technical bounce, it often does come to fruition.
It does. But and I will add to that, Dennis, that it's always, to me, contextual. What will produce a bounce is where we are in context of the things that drive the stock market, which include, I mention them over and over, but there are three big things to me. New month, new money. Money comes in through retirement plans. It's programmed commitments to retirement plans. There are options expirations, roughly call it the third Friday, but it spans 5 days. It's not 1 day, it's 5 days where there are options expirations occurring, and then month end, when the Steve Cohens of the world will true up their positions and manage their risk and determine what they're going to do next, and the index funds and ETFs will try to square themselves with their benchmark. So where are we in that context? Well, we're roughly 2 weeks out from options expirations. Well, so about when you're 5 days out of the money, that's a trade heavily preferred by quants. Quants like 5 day out of the money options, up or down, because there's a chance to drive up the underlying and produce a significant return on the option. So you know that there's a probability sometime this week that it turns, because that's the trade that will come. I think those help us think well about the stock market. You know, I always go back to the fact that if you're a doctor, you got to know human physiology. If you're a lawyer, you got to know the law. If you're an engineer, you got to go know math and physics. If you're a trader in the equity market, you must have a basic comprehension of its form and function. You could be the best Benjamin Graham analyst of bottom-up intrinsic value on the planet, but if you don't understand how the stock market works, you're not going to succeed.
Tim, before we let you go, how many years of data is your market structure based on?
In its entirety, it goes back to 2005. This is when we first ran very large tests, and it was right before the implementation of Reg NMS. In the data set you see here, we can go back to 2012. There are reasons for that. And then we keep shrinking it because things have changed so dramatically. You cannot rely on data from 10 years ago to tell you what will happen in the equity market. Why? Because of the massive shift to indexes, the explosion of leveraged ETNs, exchange traded notes, exchange traded products, the way that money continuously shifts its exposure every quarter, the way that hedge funds manage risk, the massive size of BlackRock's risk management strategy. People forget this. Its Aladdin division supplies risk management tools to $20 trillion worth of assets. Well, all of these things feed into the way that the market works today. So I think you have to shrink. It's contrarian, it's counterintuitive. It's contrary to the orthodoxy that you want to have a large data set. But in order to have apples to apples, number one, what you measure has to be within Reg NMS. Regulation National Market System was implemented in 2007. So it has to be within that. And then I think you have to go to where this huge divergence between passive and active money has occurred and make sure that you factor that in. That's what we do.
Tim, can we do one more before we go?
Absolutely.
I'm just curious too. Roblox, can you take a look at it? Because here's a stock that has just been an epic disaster for 2022. I mean, it started the year at $100.
They have earnings this week.
We're $27. The stock is obviously down significantly from the all-time highs. And, you know, a lot of people saying, wow, how low can it go? I've said before, I know these stocks continue to go a lot lower than you think. But I mean, what's the quantitative approach looking like on this? What's your system market structure, I'd say?
Not so bad. I mean, you have an increase in demand. The bad news when a stock is at 2.6, you see that's where this is.
I was going to say 1 or 2 on that one. I should have guessed.
Yep. but it's rising. So you would say, how can the underlying demand be rising when the price is falling?
Yeah.
Because it's not predicated on price solely. Price is an input. It's one of 5 inputs, but that alone, that's the problem. That's why we tell people don't trade price. Price will fool you. You have to trade supply and demand. And demand is a little, or supply is a little above trend, but has flattened out. So quantitatively, there's a chance that Roblox does all right, regardless of what it reports, because demand is rising faster than supply. That's not a lot of upside, but it's some. So you could know that going into earnings, that might be the case.
Tim Quast runs Market Structure Edge. If you want to learn more, go to marketstructureedge.com. Tim joins us every Monday, and we always appreciate it. So, Tim, have a great rest of your week.
Back at you.
And,
always good to see you guys. Thank you.
Thanks, Tim.